we're looking at, just a recap here. Alright, so you tell me why this slide is so important.
Because you need to know all of these to do your basic accounting.
Yes, okay, so it doesn't matter what I'm doing. It can be journals, ledger, it can be bank recon, it could be anything. If I keep it simple, I can always approach the question correctly, because every time I have a transaction, I'll always have a debit and a credit.
You should actually put on one of your slides that dead link.
I don't, because it's just something that some students need and some students don't. So I mention it to students at the beginning so they have a way to remember the rules. But after a while, like now, you're more comfortable than you were before. Yeah. Initially, it was foreign in terms of not knowing any of the rules, and then using that acronym can help you with the rules. But eventually, students become so comfortable with it, it's not really necessary. So I could maybe include that in 1501 because that's like the basics, the base. But this is slightly more advanced because you're taking your knowledge a bit further. Then it's not so important. Yeah, rules are always important. That's why we have that. Okay, so as long as we've got that at the back of our mind, we can then do anything. Right, where are we going to be focusing on in 1502? It's over here, right at the bottom. Right, so yes, in 1502, disclosure is so important. In 1501, you only covered the disclosure toward the end, where they gave you like statement of financial position, statement of comprehensive income, but they never really tested it in detail. They gave you one or two adjustments, but nothing major. Here you'll see a lot more adjustments. Then we covered journals. We know a journal is used to record what?
Payments and cash receipts.
Good. Okay, those are examples of
journals.
Transactions. Correct. So those transactions are recorded in the journal. So you're right. A journal is going to record things like the cash receipts and payments. And we'll have different journals for different things. So cash receipts and cash payments will affect which account? Bank. Bank will either go up or bank will go down. You actually wrote this in one of those separate slides where it was blank. Right, so this is a summary of what we covered before. Okay? Purchases and purchases returns affects who? The creditors. That's the key. And then sales, obviously, debtors. Can I have debtors with a purchase? I could, but then the debtor actually becomes my creditor. Right, so it is possible to have one business that's your debtor and your creditor. It's possible. But if they're a debtor, you're looking at the sales side of things. And if they're the creditor, then you're looking at the purchase side of things. You don't mix those two together. Okay. General journal is using the general ledger to record adjustments. Right, so general journal will be for things like prepaid expenses. Remember those? Sort of. Okay, we will cover them again. We'll keep that in mind just now. But it's always something to consider. Here's your VAT summary. Why do I need VAT? Correct. Okay, because it's part of the legislation of the country. So as a VAT vendor, do I have to collect tax on behalf of the government? Yes. Okay, what is that VAT called if I'm collecting it? Input, output.
Input. Oh no, output.
Yeah, you're collecting it. Yes. Remember, if you're collecting VAT, you're collecting it from your customers. Okay, so when a customer buys something from the business, they're paying an extra 14%. Are you entitled to it?
No.
No. So it needs to be collected in order to be paid over to SARS. Okay. Input VAT arises when we buy or purchase goods, because now we're the one, okay, paying for the VAT. And if you're paying for the VAT, is it a benefit?
Yes.
Yes, it is. Okay, you
claim it back.
Exactly. You get to claim it back from SARS. So if I'm claiming back the VAT, I'm going to view it as an asset. So I've got two different accounts here. One is a liability and one is a asset. If I have a bigger liability, meaning more output VAT than input, I'm going to land up with the VAT liability. Meaning, are you going to pay SARS? Yes. Okay, because there's more output than input. If your output is smaller or less than your input, then you'll have the opposite, which is a refund. Okay, so a refund will arise when your input VAT is greater than your output VAT, meaning we're buying more than we're selling, and you'll be able to claim that. Okay? Definitions are very, 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 very important because we're going to be looking at some adjustments. Right, so when focusing on assets, we know asset, the keyword is resource. We know the keyword for liability is obligation. If you know what an asset is, it should be easy to account for it because you know from the rules, assets increase where?
On the debit side.
On the debit side, and decrease on the credit side. Okay. Income, increase in benefit. What is the difference? Income minus expenses gives you? What does it give you?
Oh, owner's equity.
No. Income minus expenses gives you?
Profit.
Profit.
Sorry.
Okay, so profit is calculated from income and expenses. You mentioned owner's equity. What is owner's equity equal to? You're not wrong because profit is part of owner's equity. What else? What else is part of it? Capital and drawings. Okay, so capital and drawings would help you to create owner's equity. Here's a note about adjustments. When do we do adjustments? Do you remember from your basics? When do we adjust? During the year or at the end of the year?
During the year.
Possibly, but most adjustments will be done at the end of the year. Why? What did we want earlier? We wanted financial statements. Okay, so are those statements going to be prepared at the beginning or during or at the end of the year? At the end of the year. So most adjustments are done at the end of the year. You can process adjustments or corrections during the year, but that will depend on what you're actually recording or capturing in the books of the business. Right, we've spoken about a T account before. We've seen what a T account looks like. We're now looking at bank. Is bank going to have debits and credits?
Yes.
Yes. Here I've got an example. The debits represent the receipts and the payments represent the credits. Okay, because what type of account is bank if bank is bank?
It's an asset.
Good. Okay, so because this is an asset, it's going to increase on the debit side. So when I sell and more money comes into the business, then you would have more receipts. If money goes out in terms of payments for expenses, then you'll have payments. The difference between the two is going to be what we're going to look at in terms of the balance that we're going to carry down or bring down. So how would you comment here in terms of the performance of this business? Good or bad?
Good.
Why good?
Because the balance is 5,678 rand.
Positive or negative?
Positive.
Correct. Okay, so because it's a positive balance, you're starting with 0, but you're ending with 5678. Okay, that's good for the business because their cash has increased. Okay, here's your adjustments. Okay, again, revision. We've covered adjustments before. I want to see how many of these you still remember. Okay, so let's check. How long is the financial year?
12 months.
12 months is correct. Okay, if the financial year is 12 months, do the transactions always relate to the financial year?
Yes.
Do they always relate?
Oh, no. Not always.
No, not always. There are some times where you're going to have to provide for the differences, and that's an adjustment. Right, so an adjustment is trying to achieve this. More accurate financial statements. Right, so I want to take the information that I've got and I want to try to create the most accurate set of financial statements I can given the information about the transactions that I've got. Right, don't worry too much about steps here. As long as you remember your basics and how to apply them, you'll be fine. Always take things back to its element. So ask yourself, what is it? Is it an asset, liability, income, or expense? And then from there, you would then calculate the adjusted amounts. Okay. So let's see if you still remember the basics here. I want to know what is a prepaid expense. What is a prepaid expense?
It's an expense that. Yeah, I saw that. But
Describe it. So you're paying for something now that relates to the future. Okay, so if you're paying for something today, okay, are you on contract or prepaid or contract? So with contracts, what happens at the beginning of every month?
you need to pay your account.
You need to pay the account. Okay, and normally you pay the account that's from last month. Okay, let's assume that you prepaid your account. Would that be good or bad?
Good.
Why?
Because then it's in a credit.
Correct. That means your balance is actually positive for you because you're actually owed more by them. Okay, so would that meet the definition of an asset?
Yes.
Why?
Because they owe us.
Yes.
Basically.
It's a resource. Okay, so you're creating an asset. If you're creating an asset, do assets have debit balances?
Yes.
Yes, they do. Right, so debit prepaid expenses and then credit the expense. Can you motivate why we credit the expense? We actually mentioned it earlier, but let's see if you can think of the reason. Why do we credit the expense? Did I pay too much or too little?
You pay too much.
Correct. So if I pay too much, will the 12 months expenses be too high or too low?
Too high.
Correct. Because I prepaid month 13, 14, 15, 16. What must I do to the expense?
Decrease.
Correct. So that's why I decrease the expense, because it's overstated. I have too much sitting as an expense because I've got next year's expense reflecting in this year's statements. Is that okay?
Yes.
Right, accrued expenses. Give me an example. You know what the definition is? It's on the board here. So, an incurred expense for the period not yet paid. Can you think of one?
Your vehicle.
What about the vehicle?
If you bought it on credit.
Okay, so if you bought it on credit, what would that create?
It's a liability.
It would create a liability. But would you call that liability an expense?
No.
No, not if I'm buying a vehicle. Right, so here I'm incurring expense that relates to the past, but I haven't paid it. Okay, so water, electricity. When do you pay water, electricity?
At the end of the month.
At the end of the month, correct. So if you're paying water, electricity at the end of the month, the end of the month would be after or before you've used the water, electricity. After you've used it, exactly. So during the month you're using water, electricity. Have you paid for any of it?
No.
No. But have you incurred the expense?
Yes.
Yes. So how are we going to adjust our books? We're going to provide for what? An asset or a liability?
A liability.
Correct. Okay, so you're creating a liability for something that you haven't paid. So if you haven't paid for it, is your expense too high or too low?
Too high.
Your expense is too low.
Oh, too low. Yeah, because you haven't paid. Okay.
Correct. Okay, you haven't paid. So if your expense is too low, am I going to increase it?
Yes.
Yes. Where do expenses increase?
On the debit side.
Exactly. So understated expense, you need to increase it. And then you're creating liability, which we now know is accrued expenses. Right, so anything that we haven't paid will be viewed as a liability until we've paid it. Got that?
Yes.
Alright, what's happening here? Consumable inventory adjustments. Well, let's assume that we've bought lots of stationery and we haven't used all of it, is it fair to show stationery at the full expense amount?
No.
No. We need to show stationery at the net amount. Do you agree?
Yes.
Because some of it we've used and some of it we haven't used. Right, so if I haven't used all my stationery, am I going to debit an asset? Yes, because I'm creating it just for disclosure. Right, so just be careful. Remember, adjustments relate to when? What point in time?
At a certain point in time.
What point in time? Which point? So you said a certain point in time. What point in time?
At the end of the year.
Correct. Okay, so at the end of the year, I'm providing for adjustments, and those adjustments will either create a liability or create an asset. Right, so what type of account do you think this is? A consumable inventory adjustment? Do you think it's an asset? Do you think it's a liability? Do you think it's an income? Or do you think it's an expense?
It's an asset.
Yes. Okay, perfect. Right, so creating an asset. If you're creating an asset, are you going to increase or reduce the expense?
Reduce.
Correct. Okay. No. Well, okay, that's only half of it. So you're not wrong. Okay, if you said you're reducing the expense, what else are you going to affect?
The assets.
Correct. I'm creating it. So what is the asset going to be called? Stationery on hand. Right. Stationery on hand is any stationery that I've used, or that I haven't used rather. Alright, because the used stationery will be an expense. Stationery that's used is an expense. Stationery that's unused is a asset. Okay, so debit inventory, Y, asset on hand, increase, and credit stationery, Y. Why are we crediting it?
That's what's been used.
Stationery is too high, too low.
Too low?
Stationery as an expense is too high. Okay, because have you used all of the stationery?
Oh, no.
No. So do you agree it wouldn't be fair to say that I've used all my stationery?
Yeah.
It would only be fair to say I've used the stationery that I actually have used up, that I haven't. Let's say, because remember, it's stationery that you've used that you haven't sold it, or you haven't, how can I put it? It's
like pens that's in the cupboard.
Yes, storage stock, basically. Okay, so spare stock, that's it. Okay, so inventory that you have in store, okay, meaning surplus inventory, the ones that you keep in a stationery cupboard or a stationery drawer. Okay, so all the stationery that I've bought that I haven't completely used will be viewed as an asset, and we have to reduce the expense. So credit stationery, expense, decrease or increase? Where do expense increases? Where do expenses increase?
On the debit side.
Perfect. So where would it decrease?
On the credit side.
That's the answer. Right. So you're not using all of it. You need to reduce the expense. Is that okay?
Yeah.
Is it sort of coming back to you from 1501? Okay. Next one. Income received in advance. What happens here?
A client paid us in advance.
Perfect. So how would you describe that? As an obligation, as a resource?
Obligation.
Why?
Because we need to supply the stock or whatever.
Correct. So any income that you've received that you haven't earned, good or bad to the business? Bad to the business, because you're creating what type of account?
A liability.
Perfect. Okay, so if I'm adjusting my income, is my income too high or too low?
Too low. Too high, too high. Sorry, too high.
Okay, explain why.
Because they overpaid us.
Exactly. So your income would have been overstated. Right. Am I going to owe someone something?
Yes.
Yeah. So what type of account is income received in advance?
It's a liability.
Correct. Okay. Good. Making sense?
Yes.
Okay. Got that. Great. Right, next one. Accrued income. Similar to debtors. Describe a debtor to me. What is it?
Somebody who owes us money. That's
Correct.
an asset.
Good. So a customer that owes us money, which would be a
Asset.
debit. Yes, it would be an asset. So you're creating an asset. Do you agree?
Yes.
Okay, if I'm creating an asset, what account am I going to affect? No, you wrote asset there for income. That's incorrect.
Yeah, I saw that. That's why I'm writing it here.
Okay, fine. What is the effect of on the business? Will I increase or decrease my income?
You will increase.
Correct. I'm increasing income because am I entitled to more or less?
To more.
Correct. Okay, that's important. So now you're creating an outstanding amount that's going to come to the business eventually. Do you agree?
Yes.
Okay, so creating an asset, we're going to debit the asset and we're going to credit for the understatement term. Is that okay?
Yes.
All that.
Okay.
Almost.
Cool.
Okay. Right. Describe a credit loss or a bad debt. What is this?
An expense.
Yes. Why?
Because we lost money.
Perfect. Right. So where or when do bad debts arise?
When the clients doesn't pay their accounts.
Correct. And who are those clients called?
The debtors.
Very good. Okay, so similar to debtors because it's an amount that you haven't received. And if I haven't received something, it's an asset or liability.
Liability.
Well, for the provision, yes, but for the actual loss, an expense. Isn't a credit loss an expense?
Yes.
But will it affect liability?
Yes.
Yes, it would. Right, but I'm not looking at the liability here. I'm looking at debtors. Okay, when debtors don't pay. Okay, so depending on what's happening to the credit loss, so the credit loss would be seen as almost like a liability because it's, well, let me be specific. A credit loss is an expense, but a provision for a credit loss would be seen as like a liability because you're still going to have to pay it. Do you agree?
Yeah.
Okay, so debit the credit losses. Why? We're creating what type of account?
Expense.
Correct. Okay, we're creating an expense. Why do we take that off debtors? Any idea? Are your debtors over or understated?
Under.
Overstated, because will you get the payment from your debtor?
Oh no.
No, you won't. And if you don't get a payment from your debtor, they meet the definition of income or expenses.
Expense.
Yes, for not meeting the definition of income. So credit loss would be seen as an expense. You're right. Okay. Is that right?
Yes.
Okay, so no payments will be received because the payment isn't going to be made by an insolvent debtor. Right, so assets are going to be decreasing and credit loss is a?
Liability.
No, credit loss. Expense. Ooh, credit loss. If I'm writing off bad debt, it's seen as a expense because am I writing them off completely? Yes. Will you ever get them back? No, you won't. Okay, so credit loss or a bad debt is when an expense is recorded that eliminates the asset, okay, which was debtors. Right. Let's try depreciation. What is depreciation? Do you remember?
That's a vehicle because
Depreciation?
the worth of the vehicle decreases.
Perfect. So now describe depreciation to someone who doesn't know what it is. How would you describe it?
The value of the vehicle decreases every year.
Correct. The value of the vehicle decreases every year because of use. Okay, the more I use something, the less it'll be worth. Okay, adjusting journal entry. Debit depreciation, credit the accumulated. What are these accounts called in terms of the element? Depreciation is what element?
It's an expense.
Correct. Accumulated depreciation is what type of element?
Liability.
No. Almost. Negative assets. Remember that one?
No.
Okay. Negative asset is what I will record against what account? The asset. Accumulated depreciation. Okay, what does accumulated depreciation do to the asset's value?
It decreases.
It decreases it. So the more assets I've got and the more depreciation I've got, the less the... Think about it. The more assets I've got and the more depreciation I've got, the less the... What will be less? The carrying value. Okay, because what is carrying value? Do you remember?
Yes, I do, but I don't know how to explain it.
Cost minus?
Expense. Oh. No.
Okay, because it's the asset, so I'm looking at the cost minus the accumulated depreciation. Doesn't that give you the carrying value for property, plant and equipment, PPE? Negative asset, right? So what is the value of the vehicle? Its cost minus its accumulated depreciation, isn't it?
Yeah.
Okay, so if I buy something, can I change the cost?
No.
I can't change the cost. So if I can't change the cost, I'm still going to have it as part of the calculation, because the cost is how much I bought the asset when I bought the asset. Okay, but will the value of the asset change?
Yes.
Yes. Okay, the value of the asset will increase or decrease?
Decrease.
Decrease. The more I use it. So the more I use something, the less it'll be worth. So credit the accumulated depreciation because it's going to affect the carrying value of the assets. Okay. Right, so you started off by saying accumulated depreciation is a liability. Is it a liability? Not quite. Okay. It's similar to a liability, but it isn't a liability. Right, because liabilities are things that we owe. Here, we don't owe anyone anything. Okay, we're just accounting for the depreciation that affects the value of the asset. Okay, so the asset will either be worth more or worth less. Is that okay?
Yes.
Okay. Alright, so quick test. I want you to take a minute or two just to identify what these accounts are. But I want you to tell me what they are. So for example, prepaid expense, tell me.
It's paid in advance.
Prepaid
Oh
expense?
no, prepaid expenses
You're
like
right.
your contract.
You're right. You've paid in advance, not your customer. Do you agree?
Yeah.
Okay, so you can say that. There's nothing wrong with what you said there. Okay, so prepaid expense means you paid in advance. Fine. Happy with that. Now tell me more. What else? Asset or liability? Income or expense?
It's an asset.
Good. A prepaid expense would be what? Debit or credit?
Debit.
Perfect. Okay, because it meets the definition of an asset. Is that right?
Yes.
Okay. Next one.
Accrued expenses is expenses that's over time, like for a year, every month. I don't know.
Okay, so describe it in terms of asset, liability, income, expense.
It's an expense.
No, it's an accrued expense. So accrued means have you paid for it or haven't you?
It's a liability.
Good. Have you paid for it or haven't you?
No.
You haven't. Correct. Right, so do I owe someone something?
Yes.
Yes. Is that an accrued expense?
Yes.
Yes. So it meets the definition of a liability. It's an obligation to pay.
Okay.
Is that right?
Yes.
Sure?
Yes.
What do you think consumable inventory adjustments are?
It's your adjustments for the stuff that you haven't used.
Perfect. So if I haven't used something, what is that?
It's an
Good. It's an asset. Okay? Do you agree?
Yes.
Okay, so that asset hasn't been used. So if I haven't used it, does it meet the definition of a resource?
Yes.
Yes. So this consumable inventory adjustment would be for something that I haven't fully utilized. Okay, so leftover stationery, leftover packing material. Is that okay?
Yeah.
Right, so businesses don't use all their stationery every year.
No.
Some of it is carried forward to the next year. Right, what is income received in advance?
It's a liability.
Why?
Because we owe them
Correct.
the service or product or whatever.
Perfect. Okay, so you've received income that you haven't earned. Okay, once we've earned it, then it's ours, right?
Mm-hmm.
Okay, so income received in advance is?
Liability.
Great. Accrued income?
It's an asset.
Why?
Because it's income that occurs every month for a year, I don't know.
Almost. The big question is, have you received it or haven't you?
No, I haven't.
You haven't. So if you haven't received something, are you entitled to it?
Yes.
Good. So accrued income would be something that you've earned, but you haven't
Been paid.
received. You haven't been paid. Correct. Asset. Credit losses?
Is an expense, it's a liability.
It can't be an expense and a liability.
It's an expense.
Yes. Why?
It's bad losses. It's like a customer who haven't paid you for your services rendered.
Correct. Okay, so a decrease in benefit. Okay, I'm not going to get that from my customer. Correct. Depreciation?
Is an expense.
Correct. Why?
It's the value of the item that decreases.
Correct. Which assets depreciate?
Vehicle, everything that you use, like your
Good.
laptop.
Yes.
Vehicle.
Okay,
Yeah.
non-current assets generally. Well done. Okay, nice. Right, so let's see if you know what these balances are going to be for these accounts. I want to know, what balance do each of these accounts have? How do I know what balance they'll have?
You need to know if it's an asset or an expense or a liability or.
Correct. So what is land and buildings?
It's an asset.
Good. So debit or credit?
Debit.
Perfect.
Sales is an income.
Perfect. So credit or debit? Credit, 100%.
Bank overdraft is a liability.
Correct. Debit or credit? Bank overdraft?
Credit.
Credit, good. Stationery?
Stationery is an expense.
Good. Debit or credit?
Debit.
Perfect. Loan?
A loan from a bank is a liability.
It would be?
Yes.
Debit or credit?
Credit.
Good. Vehicles?
No. Debtor ABC.
Sorry, debtor ABC, then vehicles.
It's a debtor and it debits. Vehicles is an asset, debit. Creditors is creditors.
No, creditors isn't creditors. Creditors is
a liability.
Yes.
Sorry.
Okay, be careful. Capital is capital. Drawings is drawings.
Okay.
Creditors is a liability. Debit or credit?
Credit.
Good.
Interest income is a debit.
No.
Oh, it's a credit. Sorry, it's an income.
Yes.
Yeah.
Okay, interest income is income, so it's a
credit.
Credit. Perfect. Okay, great. And then you've got adjustments. We've spoken about this before. Are you going to have to adjust your accounts?
Yes.
Yes. Why?
Because the bank statement doesn't correspond with ours.
Okay, that's a bank recon.
Oh.
Okay, you will do a bank recon again, but these are adjustments for when? Year end or beginning of the year?
Oh, year end.
Year end. Okay, so do the financials have to be accurate?
Yes.
Yes, so I'm going to have to adjust those accounts to make sure that all the accounts are accurate before I present the financial statements. Right, and that's why the financial statements are prepared at the end. Okay. Is that right?
Yes.
Okay, and then we need to look at more examples.